Social media has been buzzing with claims that the IRS raked in a record $4.9 trillion in taxes this year. However, the reality is not only different but potentially worse. Let's dive into the facts, explore the aftermath, and examine the potential impact on the markets. The confusion stems from a Journal of Accountancy post dated January 4, 2024, highlighting the IRS's collection of $4.9 trillion in total taxes for fiscal year 2022. Many mistake this for the current fiscal year due to the year change. In truth, fiscal year 2023 tells a different story. Checking the Federal Reserve's data, tax revenue for 2023 fell, totaling $4.44 trillion compared to the $4.9 trillion in 2022. While some might cheer the government taking less, history suggests a potential downside. An analysis of tax revenue trends since 1980 reveals a consistent pattern. Every time tax revenues declined, a recession followed. The correlation holds true for the upcoming year, as 2022 to 2023 saw another decline in tax revenues. This pattern isn't about causation but reflects economic challenges. Factors like reduced spending, job losses, and increased savings contribute to both declining tax revenues and recessions. The national deficit, currently 133% higher year-to-date, indicates increased borrowing to cover expenses. As tax revenues continue to drop amid economic challenges, the deficit will likely widen, pushing the government to borrow more. Rather than reducing spending, this cycle often results in higher interest rates. Bearing in mind the historical context, periods of declining tax revenues have consistently preceded recessions. This signals a potential economic downturn in 2024. Despite the looming challenges, there are silver linings for investors who can identify opportunities amid economic